to Grossman, Yannick, and Ford's webinar titled Paycheck Protection Program, discussing loan forgiveness and procedures related to that topic. Today's presenters will be myself, Bob Grossman. I am a partner at Grossman, Yannick, and Ford, who splits my time between business valuation and tax matters. Don Johnston, who is a partner in our tax services group as well, working primarily on complex financial transactions and corporate taxes. Mike Weber, a senior manager, Mike, in our tax services group, who handles a lot of corporate matters as well as international tax matters for us. And this afternoon, and not included in our original invitation to all of you on the phone today, we have Dr. Kelly Hunt, who is a district director with the Small Business Administration, who kindly agreed to step in and make a few comments today with respect to what's going on at the SBA, which I think would be incredibly useful to everybody. Kelly comes in, or Dr. Hunt, I should say, I apologize for the familiarity. Dr. Hunt comes to us through a friendship with Don Johnston, who went out of his way to invite her, and she kindly accepted. So we're more than pleased to have her with us this afternoon. Note that today's goal, we had an earlier presentation on another matter as well as this one, was primarily put together to bring out to those of you on the call and to our clients and contacts as fast as possible the latest information in a timely manner. And so we were not able to get approved or cleared for CLE or CPE credits for this particular program. We are in the process of seeing that that is undertaken and completed for future programs. And if you watch as invitations come out for additional programs in the future, you'll note and see that we will be able to provide CLE or CPE at a later date. Also, I would tell you with respect to questions today, Dr. Hunt is not going to be on the phone the entire time, so we will field a few questions for her, but for Michael and Dawn and myself, we will probably hold off to the end of the session, seeing how much information we get through, and put ourselves in a posture to answer as many as we can on the phone, and then direct you, of course, to call us for any other questions. We do plan to do more of these webinars in the future, and your feedback is welcome on the content as well as the presentation. We look forward to those comments. It helps us improve our presentations and basically address and answer the needs of the community at large as to who we need to help or what information you're looking for. Today's topic, the Paycheck Protection Program. My career has spanned 4 decades, and I do not ever recall a moment in those 4 decades where the speed of information coming from governmental bodies such as the SBA and Treasury, as well as the reaction to the pandemic itself through the release of the CARES Act, as well as 3 other stimulus packages by Congress, has been so prevalent and so aggressive and quick. You know, it's an amazing thing, and I don't understand how too many people could be complaining about the proliferation of information that is meant to provide additional guidance to us because of the complexity of the law and because of just the size of the undertaking. Nevertheless, we do want to tell you that we are awaiting further guidance that we had hoped would be out today or by today. And so the information that we're going to give you, along with Dr. Hunt's comments, are intended to provide you with the latest. And then, if necessary, please understand that Grossman, Yannick, Ford, Don, Michael, and myself will do a follow-up conversation within days of getting the additional guidance to clear up anything that we bring up today that we're not able to answer. So the Payroll Protection Program, that was a program, obviously, that was enacted as part of the Coronavirus Aid, Relief, and Economic Security Act, the CARES Act, that was signed by the President on March 27th into law, which was just 34 days ago today. So the purpose of the loans was to help pay up to 8 weeks of payroll costs, mortgage interest, rent, if you had obligations in place by a certain date, February 15th, and utilities during the coronavirus pandemic and economic crisis in the United States. All payments of principal and interest and fees on these particular loans, these payroll Paycheck Protection Program loans, and I'll refer them, as will my co-presenters, as the PPP loans, is all deferred for at least 6 months. So no interest, no principal in obtaining one of these loans. A big part of it, and we'll talk about it, that's the purpose of today's presentation, the loans are also forgivable for the amounts of quote unquote payroll costs, mortgage interest or rent obligations, and certain utility costs, as we'll explain as we go through that, that you might incur as a business owner between February 15th and June 30th. Then finally, the amount forgiven is an important element, and that is basically excluded from gross income by virtue of an exclusion in the act itself. Generally, any forgiveness of debt is a taxable event subject to ordinary income tax rates, and so at the end of the day, you may walk away from the liability to some lender, but on the flip side, the federal government taxes that because you as a taxpayer has received an economic benefit, an inflow of funds that you didn't have to pay back. That's totally logical. So this element, this forgiveness element, is a huge benefit for borrowers under this PPP program as well. And then finally, you know, most businesses, especially businesses that are in a troubled state, whether it's during a financial or economic crisis or an issue like this, generally require owner guarantees, equity owner guarantees. These are 100% guaranteed by the Small Business Administration. So at the end of the day, the loans themselves, I think, are a testament of a quick reaction, a strong reaction by Congress, and you know, through the aid of the SBA and the Treasury Department, to get us to a point of getting funds out into the economy in a very massive way and also in a very speedy way. Unfortunately, when that happens, you know, when you're writing legislation, it's not always easy to nail every circumstance down. You know, at the time that the legislation is there, and additional clarity is needed to move things forward. So the law itself generally and originally mandated the SBA to provide, you know, all the guidance that we needed within 30 days of the enactment of the legislation. That would have been last Sunday, the 26th, because the law was signed on March 27th, would have been the 30 days. But again, you have to appreciate the complexity of the situation, and also to be involved in looking at this on an almost daily basis, as our presenter team is, to appreciate, you know, the number of releases, notices, and guidance that have already been out, and understanding that there's complexities that take time to navigate through. And that's really the primary explanation for us being a little bit behind on this as well. We don't know when that's going to come out. And at this point, you know, early in today's presentation, I want to turn things over to Dawn and let him introduce Dr. Hunt, and we welcome her comments on where the status of certain items are and what her take is on where we are so far with the PPP loan program. Dawn?
Good afternoon, everybody. How's my sound? Is my sound good? Hello, can you hear me?
Sounds great, Dawn. Keep moving.
Okay. Hey, Bob.
Yeah, Dawn, you don't need to ask that.
Okay, Bob, can you advance the slides?
Yeah, Dawn, I'm sorry, sure.
Yeah, so what I want to do is, first off, thank you for everybody for joining. At this point, we have 277 people. Before we're done here, we're going to have well over 300 people attend this at some point. Thank you for your Friday afternoons. We greatly appreciate it. You know, we've put a lot of time into trying to keep up with the law, with the constant changes. And, you know, with that said, you know, there are a lot of things we don't know. Guidance is not out yet. We're expecting guidance at any point, like Bob mentioned. So one of the things we thought would be very helpful is, you know, to get some help from somebody at SBA. And, you know, that's where Dr. Kelly Hunt comes in. Kelly and I have known each other since high school, which goes back many, many, many years. I'm not going to say how many. I will say that Kelly looks like she's 36 years old. Even though we were in the same high school, I can assure you, you know, we're close in age, although I look like I'm at least 25 years older than her at this point. So Kelly, welcome to our program. Thank you so much for taking time out of your day to join us.
Thank you very much. And that's not true at all. And it hadn't been that long, has it?
It's been a while.
I do appreciate the opportunity to get on today and to talk with your clients about the Paycheck Protection Program. And I have to admit, I would hire Bob Grossman to be my public relations person in my office. That was the kindest words I have heard in the last 5 weeks. So thank you very much. It has been a very difficult time for the SBA. The SBA is actually one of the smaller federal agencies out there. And so when we were tasked with, initially putting out hundreds of billions of dollars, now well over $600 billion worth of loans to small businesses, that was a very large task for us to undergo, especially since the vessels that we're using to get these loans out literally did not exist before we did this. So the PPP program was literally put together in about 5 days. And so as Dawn and Bob both had mentioned, we are still rolling out new rules on that. It was kind of like we were working on the infrastructure and working on the rules all at one time. So that has been a big issue for us. For those of you that aren't familiar with it, you can find all of the interim rules, the interim final rules, which is how this is rolling out. There are not going to be SOPs for this. It'll be interim final rules. And then it will be the frequently asked questions that are published by the Treasury, where you will find all of the information that governs the program. Those can all be found at treasury.gov. You can click on the banner on the front page and you'll get right to the location where all of the rules are published. And so we are waiting for the final rule on the loan forgiveness. And so, there are some information we do know, but not everything yet. So I'll turn it back over to Dawn. I know he has some questions for me. And then if we have some time, we could take some questions from the group.
Yeah, thank you for that, Kelly. And one, I'd be remiss if I didn't point everybody to your resume, which is on the screen. I do point everybody to the the fourth paragraph down, which I'm going to read because I think it's worthy of somebody reading it. So Dr. Kelly Hunt, an Air Force veteran, Hunt served over 9 years as a security policeman. In the Air Force, she received her doctorate degree in organizational leadership, holds a master's degree in curriculum and instruction, and a bachelor's degree in computer information systems management. And the most impressive thing there is, obviously a lot of impressive things there, but she went to Beth Center High School, the same high school that I went to, which I'm very proud of, to have an alum like Kelly Hunt out there in the workforce with us. Again, Kelly, thank you for joining us.
Thank you.
So the first thing I'm going to throw out is, you know the statistics better than I. The SBA generally administers about $30 billion a year in loans. Now we've got $659 billion of PPP loans. How is that possible with the SBA? How's that going to be handled?
Well, as I had mentioned, we are using the systems that were in place for our traditional 7A loans and the other loans that we administer. And to give you an idea of the complexity, the amount of loans that we're putting through, during PPP phase 1, we did in 14 days, we did the same amount of loans as we have done in the last 14 years. So we were literally doing 1 year's worth of loans per day. So when you log on to, the Pittsburgh Business Times or, your favorite news channel and you hear people saying the system's slow, the system crashed, that's why. When you're putting 1 year's worth of loans into a system in one day, there's going to be problems. And so we've really tried to resolve that in phase 2. We're doing some things where, like last night from 4 p.m. to midnight, the system was completely shut down for all banks that were medium and large size. It was only allowing the very small lenders to put their applications in. We're really trying to make some changes to make sure that our loans are going in from the smaller banks. And really, to be honest, I don't know if we have any banks on the call, but our small banks have been fantastic. I cannot say enough about these smaller banks. They have been well represented in the total numbers. You know, to give you an idea, in phase one, our average loan size was just over $200,000. And I mean, you hear, you know, the LA Lakers were able to somehow get a loan, and you hear about some of the Ruth Chris chain. But when you look at that, when you look at the entire package of money, over $342 billion that we had in phase one, the average loan size was $206,000. Now in phase two so far, I can tell you that the average loan size is just $93,000. So just over $93,000. So we know these loans are a lot smaller the second time around. A lot of them are going out to the businesses that really need them the most. And small lenders, these numbers were as of very late on Wednesday, small lenders have accounted for 61% of the loans that have been approved so far in the PPP phase two. So you're seeing that the large lenders are not monopolizing this in any way, that our smaller businesses are really getting access to the money they need. And Pennsylvania did very well. They had almost 6% of all dollars in the first phase. So you can see that, you know, compared to, we were ranked right under California, New York, Texas, you know, these states that have a lot more small businesses than Pennsylvania does. And we were right under there. I think we were 6th out of 50. So Pennsylvania did really well.
Yeah, and I would say from my experience over the last 3 or 4 weeks in dealing with this with my clients, I've been blown away at the banks and how so many of the local banks have been completely on top of this, providing both guidance from their point of view as far as getting their customers up, you know, through the loan process. I've been very impressed with many of the bankers that I've worked with. One of the statistics you threw out a couple of days ago, Kelly, was in the first round, even though the numbers in the press didn't indicate it, the first round, about 74% of the loans were under $150,000. Does that number make sense to you? Is that right?
That is correct. That is correct. That, you know, in our first round, we had, like I said, our average loan size was $206,000, but just over 74% of the loans were actually under $150,000. So we're expecting that percentage to be even higher this time, because like I said, our average loan size is less than 100,000. But you know, it's really hard when the news it does monopolize the big, you know, the LA Lakers got a PPP, and you know, there was, especially like with Ruth Chris and some of the franchises, it was written into the rules that franchises could get these loans. And so it was something, it wasn't that anyone did anything illegal. You know, they did have probably access to other capital, but that wasn't a requirement. That has been changed this go around. So people are required to certify that they really need this money, that they, you know, don't have a couple $100 million in the bank that they can just make payroll with.
Yeah, that, you know what, yeah, that's a very good question. We'll talk a little bit about that later. Bob and I will address that a little bit later. Kind of just, you know, on the very peripheral on that. As professional advisors, as CPAs, financial planners, attorneys, what do we need to do to help our clients move forward in the PPP process? You know, as far as getting money that they need, what do you suggest we do?
You know, Dawn, I think that the biggest issue with the PPP program has been, in talking to people and fielding complaints, you know, for 15 hours of the day, has been the fact that a lot of people are going after this loan because they know that it can be forgiven. So in their mind, this is free money. And a lot of times their bankers or their accountants are saying, hey, you need to go get this. It's free money from the government. But the thing is, the PPP is actually not beneficial for everyone. You know, it is, like you had mentioned, or Bob had mentioned at the beginning of the call, it is a loan to protect the paychecks of your employees. So if you are, some of the restaurants or some employers that have a lot of employees that are lower wage, minimum wage or just above, and they've already laid these workers off. They've been furloughed already. They're already receiving unemployment compensation. It's going to be very difficult to get those people to come away from the unemployment compensation at the level that it is, considering the state and federal unemployment, and get them to come back to work. And, for businesses, people were always concerned about businesses being closed. Well, the Paycheck Protection Program, you have to pay your employees if you're open or not. You can't hold the money. You've got to start paying it out the first day that it is dispersed. And so I think just really making them aware of what this loan is for, and that it is not, if you only have one employee or no employees, you're a single, sole proprietor or a single member LLC, this may not be the best loan for you. It might be something that you need working capital. This, as Bob mentioned, you can pay rent, mortgage, interest, and utilities, and that only makes up 25% of the loan. So if you need working capital, if you're going to need to make payments on equipment or vehicles or anything that you have that are monthly, licensing that you have to pay for, there is no money in the PPP loan for that. So if you have clients that need working capital, the EIDL loan would have been a much better option for them. And so I think that, on the front end, it's providing your clients with the, with the real facts of what this loan is and what it isn't. And then for the ones that do get the loan, it's helping them to stay in compliance with that so that they can get the loan forgiven.
Kelly, can you talk, Dr. Hunt, can you talk just very briefly about the EIDL loan that you mentioned? Tell our listeners about the EIDL loan, the EIDL.
Sure. Now, the EIDL loan is a bit different than the PPP because we are actually lending that money out directly from the SBA, where the PPP, you are actually having your loan approved and funded through a lender. But the EIDL loans are done through the SBA. And that EIDL loan has two parts to it. It has a grant that is called the EIDL Advance. And that is, if you apply for the EIDL, you can check a box and be considered for the EIDL Advance. I've never heard anyone to be turned down on that yet. The EIDL Advance is $1,000 per employee up to 9 employees. After 9 and then 10 and above employees is a flat $10,000. Everybody should apply for that. I mean, that if that portal's closed currently, but if it does reopen, every small business should try to get that EIDL Advance. You don't pay it back. You don't have to keep any documentation on how that money was spent. There are some issues with the EIDL Advance and the PPP loan. You can't have loan forgiveness on two different portions of government money on the same salary. So you have to be careful with that. But that EIDL loan is a great opportunity. Then once you go through the advance, then your application is sent on, to the loan review. And then you'll receive an email where they're going to tell you how much money that the SBA is willing to offer you in a loan. Now that loan is for for-profit businesses, 3.75%. For nonprofits, because these programs are both open to 501c3s and some veteran organizations, so a lot of nonprofits can apply for these. If you're a nonprofit, that EIDL loan is 2.75%. And the great thing about those loans, they are up to a 30-year term on those loans. So you're getting some working capital that you can use any way that you need to for your business at 3.75, which is still a really good interest rate for a business loan, payable over up to 30 years. And I have actually heard of loans that were made for maybe $200,000-$300,000 that got the full 30 years. So it's a great opportunity, and it provides the working capital or payroll. You can use that money for anything you want. On the PPP loan, if you're not going after the loan forgiveness, if you're doing that loan just because you need the money and you're not going to ask for forgiveness on that, that loan is only 1% interest, which is fantastic, but it's only a 2-year term. So your monthly payback on that loan is going to be extremely high. The PPP has a 6-month time deferment on your payment and interest for 6 months. The EIDL loan has a 1 year, so you're not making payments on that loan for 1 year. So two completely different options, but really both options that can be really work for a small business.
That's good information. Thank you for that. And I would just mention that the EIDL, there is information on our website. If anybody wants to see a little bit more information on that, it's on our website under our tax research documents that we released. Dr. Hunt, you just mentioned that the PPP, it can be forgiven, but in your mind, are there situations where you would use that money for something other than payroll and maybe use it just for working capital? Maybe you're in a situation where you have to meet rent and you cannot be open, so you need to use that PPP for rent. Is that okay, knowing that it's not going to be forgivable, but you need to make your mortgage or your rent payments? Is that permitted?
Yes, we're actually hearing from businesses that are doing that, because the PPP loan goes pretty quickly. Once your loan is put into the portal, that your local bank approves it, the SBA verifies it, a loan number is assigned. Once that happens, that money has to be dispersed within 10 calendar days. That's what the rule says. So that money gets out really quickly. EIDL has been extremely slow, and a lot of businesses can't wait on EIDL money. So if you have a business client that's in a situation where they need some capital and they need it right now because their business is not going to reopen when this is over if they don't have that capital, we're hearing from people that are getting the PPP loan and are not asking for forgiveness, and they're just taking it at the 1% with the 2-year term. And so you can do that. You just don't ask for the forgiveness. It's like I said, it's going to be high payments, but you can always try to refinance that, but as a last term, it would be better than putting money on a credit card that you have at 20% or 14% or something like that. So it is an option that you can do.
Okay, so I've got 2 more short questions here. I know you need to get out of here quick, Dr. Hunt. So my first question is, if I get a PPP loan for, let's say, $100,000, and I only spend $80,000 on qualifying expenses, am I going to be able to exclude up to $80,000 of that, or is it a one for? Is it all or nothing, or
all or none? Yeah, that guidance is what we both had referred to earlier in the call, that we are awaiting that guidance to see what that formula is going to be. I can tell you that the interim final rule that we have now states that if you do not meet that, the requirements of the 75-25, and you don't spend it exactly the way that you should, that you will be responsible to repay some or all. So I take it that by saying some, there will be some type of prorated scale that will allow you to have some of that forgiven. Now, some people borrow, they do their PPP application and they realize that they actually applied for more money than they need. If you contact your lender before that loan closes, they can actually adjust that number down. It cannot be adjusted up, but it can be adjusted down. You also, one thing, I had a call yesterday from a business that received an $8.7 million PPP loan, and they want to return it. They feel that they, with the new rules that have come out, discussing, the certification that you have to make that, you were not able to get credit anywhere else, or you didn't have access to funds anywhere else. They felt that they could not say that in good faith, and so they wanted to return that. And you can return the funds. You can just, contact your bank, let them know we are still waiting for some guidance on that, but there is a way to do that, and that'll be something that we can do. And I also want to inject here too that, all of these stories that you've seen, on the news with Harvard or, Ruth Chris and stuff, all of those funds that you're hearing that have been returned or they've declined to accept the funds, all of those funds are being put right back into the PPP pot for businesses, for small businesses.
Okay, thank you for that. Last question, Dr. Hunt.
Sure.
And I apologize, I know we've addressed this. So any insight at all as far as when guidance will be coming? Some of my clients are 3 weeks into
I know.
funds, and we're not really sure.
Yeah, this is really awful. I know it is very difficult. And all I can say is, if you have clients that are in that position, if you're a business and you're in that position, do the very best you can to abide by what you put into your loan application. You filled that out. You were the one to say, here's how I was going to spend the money. Do your very best to do that. And we are expecting that. Even yesterday, some new guidance came out on some other areas, and it said at the bottom of that guidance that the loan forgiveness information is going to be released very soon. So just, be doing the best you can with the information you have at this point, and I think that you'll be okay.
Dr. Hunt, I cannot thank you enough.
And you could call me Kelly.
Well, I know you as Kelly.
Thank you. Yeah.
Dr. Hunt, thank you so much. I cannot thank you enough.
Thank you.
Thank you, Dr.
And I
Hunt.
appreciate it.
I was just going to say the same thing, Dr. Hunt. We greatly appreciate you being on here, and I'm sure your comments were helpful to everyone on the call.
Sure. And if there's anything I could do in the future, I am more than happy to jump on and talk to you guys anytime.
Well, thank you. We do appreciate that.
All right. Thank you, guys. Have a good one.
Take care, Kelly.
Bye.
Okay, Dawn, I'll pick it up.
Sounds good.
Okay. So obviously, as Dr. Hunt mentioned, this is an expansion of the SBA 7A program. I'm going to skirt through a couple of these slides only because she touched on some of this information already, and we don't want to be repetitive with the minimum time that we have. There's just some factual information about the loan. Some of it is things that we've known and read on the SBA website. Some of it is information that was provided by Dawn, who attended one of Dr. Hunt's discussions just the other day. So these slides that you see in front of you now, these are just the references if anybody has the interest to look at any of this information on the internet to the best you can. I mean, the law itself, the application of the law and the ability and eligibility for the loan in the first place is contained in Section 1102 of the CARES Act, and the loan forgiveness provisions are in Section 1106. The rest of this just illustrates the number of releases that have been put out in the last 15, 18 days. I mean, some of it dates back to early April, but most of it's in the last 2 weeks, 2.5 weeks. And it is, I'm sure for business owners, it's hard to understand how the wheels of government can move so slowly. But in this case, I really do feel strongly that they've done as good a job as humanly possible. If you think about it, just 60 days ago, or maybe 75 days ago, everybody's 401k was up and life was good. Nobody thought a word about COVID-19, and all of this has happened and transpired in just 34 days. So let's talk about what we're here for today. And what we're going to plan to provide you as best we can is Michael and Dawn and my impressions of how the rules mechanically are intending to work. We haven't come up with this as a trio. I mean, we've discussed this with tons of people. We've looked at hundreds and hundreds of documents trying to discern this. So we put a great deal of thought into it. And I think you'll understand as we go through this, there's a good rationale for these thoughts. And then to the extent we can, we'll answer your questions. So obviously the big thing that we're talking about here is the forgiveness itself. And that is one of the most beneficial aspects of the PPP loan, if that is what you're going for as the borrower. I think this second paragraph, this second point is critically important. And Dr. Hunt reinforced this, and both Dawn and I mentioned this already. The mechanics of the loan forgiveness, the process of getting the amounts that you borrowed forgiven, they're basically rooted in this idea that the borrowed funds were not there to give you an economic gain, if you will, over this 8-week period, but instead was meant to alleviate some of the stress of the coronavirus pandemic by virtue of giving you sufficient monies from the government, essentially tax-free, that would be used to maintain those payrolls that you had prior to the outbreak. And that's really what this loan is all about, as has been mentioned already on this call, multiple times, including Dr. Hunt. So you do have to think about that. If you have a business that continue to operate, if you will, without any interruption, and you borrowed monies to pay this back, ultimately, I don't think it's going to work. The determination of the amounts that you borrowed under the plan, how can they exactly be forgiven? Well, that's kind of a multiple step process that requires, careful consideration of the statutory guidance in the law itself, and then all of the later releases that came from the SBA in consultation with the Treasury Department. So there's a lot here. I can assure you, as I said, that Dawn and Michael and I have spent a lot of time breaking this down as best we can. And so we're going to start to go through these steps. Go ahead, Dawn.
Yeah, go back to that last slide, Bob.
Sure.
You were talking about the mechanics of this. In researching this and in talking with contacts from the SBA, one of the main objectives by making this PPP loan, basically allowing funds to go out of the SBA or from the SBA as a loan to fund almost 2 months of payroll. The objective was to keep people off of unemployment, because by keeping people off unemployment, you're able to keep the people on unemployment that need unemployment and are not already on unemployment. So if you put millions of people on unemployment, if you can avoid that, it's going to avoid a huge mess with respect to unemployment. So the objective is and was keep people off of unemployment. And there are situations where people who would go on unemployment may make more on unemployment, especially with the additional unemployment benefits have been issued, the federal unemployment benefits have been issued. But this PPP loan, the way it's set up, you need to spend the money within 8 weeks from when you get it, which means that if you get the money tomorrow, the clock starts tomorrow, and you need to call your people off of, you need to call people so they get off of unemployment, because you need them, you need to start paying them as soon as you get the money. So again, the objective is to keep people off unemployment, because the government knows that once people go on unemployment, in some cases, it's going to be hard to get them off of unemployment, and they didn't want that to happen. Go ahead, Bob.
Yeah, we're gonna talk about that more as we get into there, but that's an important point. I mean, this bill, as Dr. Hunt said, is really about protecting jobs and keeping jobs. So it's another governmental source of supplementing salaries, not really an enrichment process for privately held businesses and smaller businesses. So the rule itself, the general rule is that the PPP loan, that amount will be forgiven in its entirety if the following conditions are met. And some of this came out in the statute, but most of it came out in conjunction with frequently asked questions that were issued after the enactment of the law that provided some further guidance for advisors and taxpayers and borrowers. So not more than 25% of the forgiveness amount can be used for quote unquote non-payroll costs. And you'll see as we go through this dissertation that we're going to address a lot of terminology, because terminology is what it's turning on, and it also is where we're encountering as advisors a certain amount of consternation that we don't really understand all of the implications of all of the terms. So you have this 25% forgiveness amount. So what is that saying? Well, generally it's saying simply that the loan is $100,000. You're not going to spend more than 25% on non-payroll costs. The employee headcount is maintained, meaning you have the same headcount, now as you did at the test period, and that the compensation levels for employees that earn less than $100,000 a year is maintained. So it's really doing exactly what Dawn just mentioned. I mean, the fact of the matter is, you're not going to get this forgiveness unless you maintain those salaries and move it forward. So to the extent that any of these factors ultimately aren't satisfied, then you're going to get a portion of the loan that will not be forgiven, and that will become one of those 1% 2-year loans that Dr. Hunt mentioned, that, if you have the inability to pay it off, that difference in 2 years, you're going to have to go out and refinance it. So let's talk about the forgiveness section, and the section that covers that in the CARES Act is this section 1106. And this is right out of the law itself, out of the statute. First of all, an eligible recipient of a PPP loan shall be eligible for the forgiveness of the indebtedness on a covered loan, which is an important term, in an amount equal to the sum of the following costs incurred and payments made during the covered period. So I think everybody that has gotten a PPP loan is somewhat familiar with these, because these rules are very similar to the rules in section 1102 which had to be met or at least estimated in conjunction with the application process. So those costs include payroll costs, interest, not principal, but interest on any covered or uncovered mortgage obligation, which is simply an obligation that was in place on February 15th. And there's no principal payments allowed on that mortgage obligation to be considered in conjunction with this loan forgiveness calculation, nor are you able or allowed or permitted to pay prepayments of interest on that. Any payment on any covered rent obligation, and the rent obligation, of course, is something that, again, had to be in place and in force as of the February 15th date, and then any covered utility payment. So let's take just a minute and let's talk about what those mean. Okay, so a covered loan, obviously, is the PPP loan that we're talking about. A covered mortgage obligation is any indebtedness or debt instrument incurred in the ordinary course of a business that represents a true liability to the borrower. That's pretty obvious. Is a mortgage on real or personal property, meaning a mortgage against equipment, and it was incurred before February 15th, 2020. So they don't want somebody going out and getting a new mortgage, obviously, and using that payment of interest on the new mortgage to offset these. That's the general rules for the covered mortgage obligation. The covered period, and Dawn alluded to this earlier, is the 8-week period beginning on the date of the origination of the loan, and we'll talk about that a little bit more. A covered rent obligation is the rent obligated under a leasing agreement in force before February 15, 2020. This is an interesting one that leaves an open question for us. If you go back to the mortgage, you can see it was indebtedness on any real or personal property that was mortgaged. Over here under rent, it does not talk about personal property as being able to be leased under here. We suspect strongly that will be the case in the final guidance, that if you have equipment rentals on operating leases, that will count in this calculation, but that's not been absolutely clarified to this point. And then covered utility payments, which include the items that you would normally think of utilities: electricity, gas, water, transportation, telephone, or internet access, for which service was in place prior to February 15th again. It is a remarkable thing to me that we're basically 2.5 months out of the start of this pandemic. So then you have to get into looking at the calculation itself and the eligible recipient, which is you, right? The people on the phone that are borrowers. The expected forgiveness amount will be the amount that the principal lender or that the lender can reasonably expects the borrower to expend. So you see how these are the same amounts or the same items that we just talked about that essentially are considered in conjunction with the application for the loan. Now the payroll costs are what you see on the screen. And Dawn, why don't you take the payroll costs?
Sure. So the payroll costs, and again, we're trying to calculate what goes into the payroll costs. And remember, for loan purposes, we need at least 75% of our total costs to be payroll costs if we want to exclude 100% of the loan from being, as far as it being forgivable. So salary, wages, commissions, or tips. First off, capped at $100,000 annually per employee. And that shouldn't be a surprise, because when we did our applications, that $100,000 was in the calculation when you did your application. We've received a lot of questions on exactly how to what do you include there. And at the end of the day, it's gross compensation. It's whatever you're paying somebody, whether it be on a weekly basis or every other week. It's the gross compensation before any deductions is the starting point. It also includes employee benefits. Those employee benefits can include health insurance, eye care, dental, vacation costs, parental family, everything you see here, sick leave. So basically, you can almost think about it as the cost that you are paying, both gross compensation and benefits that you're paying to your employees. It does not include taxes. Employer taxes are not included in that calculation. We get a lot of questions on that, whether employer taxes are included, and employer taxes are not included. Go ahead, Bob, you had a comment?
Yeah, I'm sorry. I was going to say, obviously missing here from this definition of employee benefits is employer paid life insurance. So we're not sure that life insurance itself is going to get in there, because you can see the gist of it is to protect people's health care benefits and their retirement benefits. And life insurance is kind of a benefit above and beyond. And I guess could be thought of in the same manner as perhaps an employee that has a company car. That wouldn't be in here either. And we don't think that's going to be in the final legislation. It is your traditional benefits, as Dawn just went through.
Yeah, let me make a final comment before we move on about item D here. So for a sole proprietor or independent contractor, so anything that a business, whether it be an S corporation, C corporation, or partnership, anytime those businesses are paying a sole proprietor or an independent contractor via a 1099, i.e. they're not on payroll, that does not get included in payroll costs. Now, there have been some differences here, because in the original statute, it included independent contractors in the original statute. So there was some confusion, especially during the application process. But one of the interim rules came down and specifically addressed independent contractors and sole proprietors. It excludes them from the business, and it allows both sole proprietors and independent contractors to apply for a PPP loan on their own. So if you have a Schedule C business, if you're a single member LLC and you run your business personally as a sole proprietorship, you need to apply on your own, and you should not be picked up by any company that's paying you via 1099. We've got a lot of questions on that, and it makes sense we have a lot of questions on that, because they kind of flip-flop this one from the original statute to where it landed. There was a change.
Okay. We are going to, yeah, let's move on then. So further clarification of payroll costs, and these came out through the frequently asked questions issued by the SBA. Payroll costs do not include, as we said, any payments made to an independent contractor, as Dawn just mentioned, or any adjustments to gross wages, either up or down, for the payroll taxes. I think you mentioned both of those, Dawn, I'm sorry. But it also does not, it does include, I'm sorry, it does include any payments made to general active partners. So that was an area of clarification that was lacking that came out through the FAQs. I don't know, Dawn, I know you've looked at this pretty closely. Do you have any comment on that at all?
Yeah, initially there was a lot of question when partnerships were doing the original applications. We were getting different information from the banks as they were trying to interpret this. So at the end of the day, what the rule is, if it's a partnership, you include in the calculation of payroll any payments to partners that are included as self-employment income, which could mean both guaranteed payments and just ordinary flow-through income. If it's included in self-employment income up to $100,000, it should be included in the calculation.
Okay, thank you. So let's take what we've learned so far in the conversation, and let's start to take a look at the calculation and some of the mechanical elements of the calculation that is important in considering how to obtain the loan forgiveness that you're looking for. The first step is obviously kind of a broader step, and we look at this in layers or steps as a three-phase process, only because there's like layers of testing that gets you to the end. And if you think about it logically, the way we've kind of evaluated this is if you suggest that a borrower borrowed $500,000, well, the best way to get that entire $500,000 forgiven is spend it on covered payroll and covered allowed expenses, if you will, or eligible expenses, as we've discussed. And then there's a secondary level that says 75% of that $500,000 has to be spent on qualified payroll to get total forgiveness. And that's a motivating factor that came through to again elaborate on the point of this loan is to keep people employed. So at the end of the day, you're in a circumstance, a situation where you have to beat those first two thresholds before you worry about head counts and before you worry about wage reductions. So it's a kind of a 3 or 4 step process. So we'll start with step 1. We have to look at the 8 weeks. So the statute defines this date, the date of origination or the date that the 8 weeks begins is the date of the origination of the loan. Now, that's another item that we really weren't sure what that word origination means. I think all of us have an idea on the call of how a loan originates, but is that the application date? Is that the date of approval? Is that the date that they accepted your application, or is it the date that you get the money? And so the frequently asked questions came out that were released by the SBA, clarified the start date in question 20 as the date that the lender makes the first disbursement of the PPP loan to the borrower. So when the money gets there, in other words, the clock starts ticking the day that your PPP loans are deposited into your bank account. So that's the first critical factor, is to understand what that date is. I would also tell you there's a lot of consternation about that date, and there's a lot of push in the development of this final guidance to make that date a little more flexible. Whether that'll happen or not, I don't know. I give you examples that we have clients that were approved for the loan, the monies were put into their account, and then Dawn and I were asked that, we can bring our employees back, but if we do, they're not going to have anything to do because our customers are not back up yet. They're still closed down by the government. And so, our response to date, based on what we know and the guidance that we've been given, is simply that you have to bring them back. This wasn't meant for you, this was meant for them. And as Dawn mentioned, earlier, this is meant to keep them employed as opposed to going on unemployment. And if they have nothing to do, as an employer, you have to either decide what to get them to do or not. Think about it, if you apply correctly and you spend it correctly, they're coming back on the government's dime, right? They're not coming back on your money at all. So even if you find alternative things that aren't profitable because your clients aren't working yet, you're still re-employing these people, and that's the purpose of the loan. The AICPA, which is the American Institute of Certified Public Accountants, one of our national organizations, probably the biggest one, is trying to move these dates. And a couple of their recommendations, which just came out the day before yesterday, regarding the start of this covered period, include the 8-week covered period and how they believe it should align with the beginning of a specific pay period, not the date that the loan proceeds are received. So kind of give you a jump and an ease of compliance with getting forgiveness later by having the 8-week start, on the end of a pay period. And I think this is kind of valid. The 8-week period should commence once stay-at-home restrictions are lifted, not when the loan proceeds are received. It's easy to understand, if you've looked at this as closely as we have, the validity of both of these from a thought process. But if you comply with either one of these, you're kind of going against what Dawn and I have been saying, Dr. Hunt, that this was a payroll loan. And so if you have to leave people at home and they're getting paid by virtue of this, it just simply means they're not getting paid by unemployment on the flip side. Dawn, any thoughts on that?
Yeah, Mike? I think the key there is they're not on unemployment. So when you need them back, they will need to come back. They will need to come back and work for you when this ends. Because again, the thought process in a lot of ways is once people go on unemployment, they figure out that getting money for sitting at home and not doing anything is not the worst thing in the world. Yeah,
that's exactly right. So let's go on to the next step then. So we have to determine the amount of loan proceeds utilized in that covered period, that 8-week period, for incurred or paid payroll costs. And it's not really that, there's a typo on the screen that says incurred or paid. The language actually reads incurred and paid. And so there's a question that we keep getting from clients and the borrowers as to what happens if you're a cash basis taxpayer, you're not paid till later. Unfortunately, we don't know the answer to that, but in our minds, logically, based on generally accepted accounting principles, just because you haven't made a payment on Tuesday of wages that were accumulated in the last 15 days doesn't mean that, the number of days between the date that you received the loan proceeds and payday were not costs incurred. But we still have to wait for that to make sure. And we don't think it means that the costs were incurred, and not only incurred, but they were paid, as you might read that, incurred and paid. But I think it's a subtle difference. We kind of take the opinion that it's costs that were incurred by the business and other costs that were paid by the business, and the sum of those two are the measuring point for this. So you have to determine the total amount of loan proceeds utilized in the covered period for payroll costs and other allowable costs, and we'll label those for ease of discussion, the covered expenses. And if the covered expenses do not rise to the level of the loan proceeds, then the difference doesn't qualify for forgiveness. And that was the example I gave earlier, and we've talked about this over and over again. To get the maximum amount of loan forgiveness, you have to spend all the money. You not only have to spend it, you have to spend it the way that they want you to spend it. So the first part of that is you spend all the money. So you got company A borrows $1 million under the PPP. In the covered period, they incur and pay $850,000 of covered expenses. That includes both covered payroll and covered ancillary expenses that are permitted. In that case, they didn't spend the whole $850. So they're not going to get debt forgiveness on the $850. They're going to basically have $150 that doesn't qualify for forgiveness and ultimately must be paid back. And they'll either have to give that back to the bank and pay the loan down, or they'll have to amortize it over the 2-year period at 1% interest. So that's the first step. They borrowed $1 million, they only spent $850. The way we think the second step is based on the SBA's 75-25 rule. This is kind of an interesting thing. If you look at the statutory changes that were facilitated by the CARES Act, these changes that we've talked about so far do not affect the Internal Revenue Code. These changes basically affect the Small Business Administration Act. And so they didn't put any details like 75-25 in the CARES Act, but they did do it in follow-up correspondence with the, not correspondence, excuse me, guidance through frequently asked questions a little later, and that citation is noted up there. What it basically says in that frequently asked questions was not more than 25% of the loan forgiveness may be attributable to non-payroll accounts. And I was asked today whether that was accounts or amounts, and I told my assistant amounts, but must have been my sloppy writing. I apologize for that. So that's a typo as well. It should be non-payroll amounts. So, you know, even though it wasn't in the law itself, the SBA retains the capability and the authorization to make these changes through this frequently asked questions. And basically, they noted in their frequently asked questions that they determined that the non-payroll portion of the forgivable loan amount should be limited to effectuate the core purpose of the statute. So I apologize. Again, we're running at the 11th hour trying to get this in, waiting for guidance. We have a couple typos we didn't clean up. So I know you're out there, Carissa. Make sure that gets changed. Effectuate core purpose of the statute. Again, probably, folks, my poor handwriting more than my assistant. So when you go through there with that 75-25 rule, so the next step or the next protocol to the prior procedure where we saw we only had 850,000 of potentially forgivable loan. Now we look at that 850,000 and we say, how was that spent? You know, basically, was the amount incurred or paid from the remaining 850,000? Was that 75% for covered payroll? If yes, then you simply move on to step 2, which Dawn's going to address in a minute, and deals with staffing levels or employment levels. If other non-payroll expenses exceed 25% of the remaining qualified loan, there is a further limitation to this first step. In other words, you won't qualify for a full $850,000 forgiveness. It'll be something less than that, reduced, we think, based on what we know right now, by the gap between 25% and whatever percentage we spent on non-payroll expenses. So again, if you look at the example, Company A incurs or pays $255,000 for non-payroll covered expenses. Okay, we know that 25% is the gap. That represents 30% of the $850,000. The amount of Company A's potential loan forgiveness then is reduced by the 5% excess, which is $42,500, leaving, before you go to steps 2 and 3, $812,500 is potential loan forgiveness. That's not been laid down in absolute guidance, but it makes perfect sense to us. It's rational and economically reasonable, and it does encompass a forgiveness to the extent that, you know, you as the borrower use the funds that you borrowed under the PPP program to facilitate payment of payroll. Guys, Mike, you guys got any questions?
Yeah, Bob, one thing I just wanted to mention here is that if this is the way that the rules ultimately shake out, that I've had, conversations much like you and Dawn have had over the last couple of weeks. Clients are trying to figure out what in fact do they have for rent and some of these other costs, and then backing into the covered payroll number so they still obtain the full forgiveness on that 25% other costs, if you will. Now, depends on what your intent is on how you're prepared to use this money. But if you just think about it from a business owner's perspective, they're concerned about how do they cover some of their other costs and perhaps not their payroll. So to effectuate the maximum allowable forgiveness there, they're starting with that number and then backing into what the payroll has to be, of course, subject to the other limitations that we're going to talk about as we move forward.
Okay. That's a great point.
Yeah, and then the last comment I'll make about that is, remember what Dr. Hunt said. What the statute and the guidance says is that all or some may be forgiven. So it sounds like we're going to be able to do the pro rata calculation like Bob shows here, and like he pointed out, it's not specific guidance at this point, but we're anticipating based upon the that language that we're going to be able to do a pro rata calculation.
Yeah, and we have seen some postings on the internet and had some comments from clients and contacts who have observed other people here and there, very rare, but here and there, people saying that it's an all or nothing undertaking, as Don posed in his earlier question to Dr. Hunt. I just don't see how they could do that, or how that would economically be fair to the borrowers to make it an all or nothing circumstance when maybe 85% of the loan, got spent as they directed, and 15% was just a little bit of an overestimate.
Yeah, and let me answer a question that we just received regarding the 8-week period. Somebody asked the question, what's the specific start date of the 8-week period? Is it the day you sign the loan? Is it the day the bank approves it? What is it? The 8-week period starts the day the money is in your account. So if you receive the money today, you have 8 weeks from today to spend the money. Okay, so it's 8 weeks from when you have the cash. I'll just answer that question. That one just popped up before I move on to step 2.
Okay, and I had a question from another individual, just so you know, a series of questions, but the one that fits here is that there's been some confusion related to the percentage of the PPP loan that must be utilized for payroll costs. Is it 75% or 80%? The reason people kind of look at it as 80% is, 2.5 times, salary per month. So it ends up being 20% more than 8 weeks of salary. It's definitely, without question, 75%. It's defined in the negative by virtue of the frequently asked question that says that the non-payroll expenses cannot exceed 25%. So that's a definitive answer on that point. And with that, Dawn, we'll move on to step 2, so we keep it moving.
Okay, so and let's just briefly review where we are before we get to step 2. Obviously, trying to figure out how to do the calculation for the loan forgiveness. Okay, once we qualify for the loan, we have the money in our bank account. We want to work, we want to move forward to make sure that as much of this is forgiven as possible. The first step, like Bob talked about, you've got 8 weeks to spend the money. So if you get $150,000, you have to spend the money within the 8 weeks. The second thing that Bob talked about is the 75%. If you want all of the funds to be forgivable, or all the funds to be forgiven and not have to pay any of it back, at least 75% of the $150,000 that you received has to be spent on payroll. Okay? And then the next step, the next calculation, we're moving to maintaining employee levels. Basically, what this criteria requires is that you are not laying a bunch of people off, and you are maintaining your employee level. And it talks about full-time equivalents. Okay, so the amount of the loan forgiveness will be reduced if your full-time equivalent reduces from 2 specific points in time. Okay, so there's, just so everybody's aware, you'll be able to see all of these slides later. You'll be able to print these off if you want to review them afterwards. You'll be able to see all of these and read this language in detail if you wish. Bob, go to the next slide. So the way this calculation works is you get to choose one of two different ratios, okay? And it's based upon your full-time equivalents at two different points in time, okay? So you would take the amount of the loan, and let's assume it's a $100,000 PPP loan. I would take that $100,000. I'm already assuming that I spent it all in 8 weeks. I'm assuming that I spent 75% on payroll. And then I take this and I have to do this calculation for full-time equivalents. The first ratio is the number of full-time equivalents during the covered period. That's the 8-week period where I'm spending my money. I divide that by the number of full-time equivalents during the period from February 15th of 2019 through June 30th of 2019. Or the second alternative, the second option I have, is I look at the number of full-time equivalents during the covered period. Again, it's the 8-week period, divided by the number of full-time equivalents during the period January 1st of 20 through February 29th of 20. I get to pick the better option here. Okay, so let's go to the next slide, Bob. I'm going to show you this in basically how this would work. So here's how the test is shown. I have a $100,000 PPP loan. 64, that's the number of full-time equivalents during the 8-week period. The 62 is the number of full-time equivalents during the period 2019. So if you remember from the last slide, the period was the first 6 months of 2019. So the first 6 months of 2019, I had 62 employees. So 64 divided by 62, it's more than 1, which equals $100,000. So I have no limitation because I have more full-time equivalents now during the 8-week period than I had last year during the specific period that's included in the statute. The second test would be, which is the second period, the 64 in the second line item down, 64 employees, full-time equivalents during the 8-week period divided by 72. That 72 is the full-time equivalents during the period January 1st of 2020 through February 29th of 2020, which was 72. So that's 88%. So you can see that if I was using that factor, I'd only be able to exclude 88,000. I get to choose the better option, which would be obviously 100. So $100,000. I have no limitation. So I have no issue with my full-time equivalents. So obviously you can go a lot of different ways here, depending upon your specific situation. If you do these calculations and you're at 50%, so for example, instead of the second number being 62, it was 32. Again, you're at 100%. So if you're growing and you have more full-time equivalents, you shouldn't have a problem. If you're decreasing, if for some reason your full-time equivalents decreased by 50%, then you're going to have a problem, and part of your loan is going to have to be repaid because you reduced your full-time equivalents. And we'll get to some other silly things that come into play after the fact that you also have to consider. Again here though, you get to choose the higher ratio of the two to determine the change in your full-time equivalents. The bullet point at the bottom talks about seasonal employer. If you're a seasonal employer, meaning that the majority of your payroll is in the first 6 months or possibly last 6 months, the SBA has the option to determine how they want to do the calculation. They may require you to use the period February 15th, 2019 through June 30th, 2019. So if you're a seasonal employer, that rule is important to you. So definition of full-time equivalents. So a couple points here. First off, full-time equivalents, it's not defined, and we don't know what the answer is yet, exactly what full-time equivalent means. There are a lot of questions as far as people assuming that it means something related to other SBA loans. We're not going to make any guesses because when the guidance comes out, they're going to have to tell us what full-time equivalents are for this purpose. And it does talk about average full-time equivalents over the measurement period. Okay. The other thing to keep in mind here is those dates that I had on the last slide. Those dates are different than the the dates that were used in the application process. So just keep that in mind. We can't just assume that the dates are the same, because the dates are not the same as the dates that were used in the application process. There are specific dates, as you can see in my slides. Okay, so that's all I want to talk about with respect to full-time equivalents and maintaining your employee count, your full-time equivalents. There's another calculation needs to be done. Step 4, it's step 3 on our slide, but it's really step 4 here, and it talks about the reduction in payroll, reduction in compensation per employee. And I'll let Michael take over there.
Hey Mike, before you do that, why don't you explain what people are using as full-time equivalents now in conjunction with similarities to the retention credit?
Yeah, so the retention credit, when that information was released, the way that full-time equivalent employees were calculated for that purpose pointed to a different or actually specified Internal Revenue Code section, which also related to the Affordable Care Act and how full-time equivalents were determined there. Related to the loan forgiveness, everyone's just sort of guessing, I'll call it an educated guess, that the full-time equivalents are going to follow the same set of rules. However, the language that was in for the retention credit is not in the code for the loan forgiveness. So we're waiting on official guidance. I know we said that at the very beginning, but this is one of the key areas that we're waiting for guidance to come out. And if you look at the AICPA's recommendations, of course, they illuminate this as being one of the major points that they absolutely want guidance on. So we'll see where it shakes out. But I think if you just a quick Google search will find that almost every single practitioner out there is conveying the information the way that we are today.
Okay, so let's move on to step 3, and Michael's going to talk a little bit, as Dawn said, about the reduction that's attributable to salaries and wages that can serve to reduce the amount of your loan that might not be forgiven.
Yeah, and I'm not one to read off the slides, but I think to start out, I think it's very important to understand exactly what's in the code, and that is what's highlighted in black print here. And it's very important, again, because the AICPA has released recommendations with respect to this specific issue. And I have some examples as we go through a couple of the slides here just to illuminate this point. But take a look at this. It says the amount of the loan forgiveness shall be reduced by the amount of any reduction in total salary or wages of any employee during the covered period, okay, which we talked about, which is in excess of 25% of the total salary or wages of the employee during the most recent full quarter during which the employee was employed before the covered period. Now, I'm sure we have a lot of astute observers out there, and you'll quickly figure out that the covered period's 8 weeks. The most recent full quarter could be 12 or 13 weeks, depending on how you're looking at it. So you have sort of an issue with respect to how that 25% is going to be calculated. Again, I have some slides on this, and I'll highlight that as we go through. As we mentioned before, this 25% reduction does not apply to anybody making over $100,000 in annualized pay during 2019. So you had somebody making more than that, and you drop their wage by more than 25%, there's no limitation on the loan forgiveness. The last point down there with respect to the tipped employees, those are also eligible for forgiveness for any additional wages paid out to those employees. Move on to the next slide.
Okay.
The wage, if you do have a wage reduction, and again, we'll discuss this a little more detail on the last slide to step 3, but if you do have a wage reduction that occurs between February 15th and April 26th, you have an opportunity to cure that by June 30th. And if you do that, then your loan forgiveness will not be cut down by this particular step. So I'm going to talk about that in a little more detail as we move on. Let's go to the next slide. Okay, so this is what I was mentioning from the very beginning. Currently, the CARES Act includes a provision for a reduction in loan forgiveness for any employees whose compensation decreased by more than 25%. And as I mentioned before, you've got a 12-week quarter, that's the measurement, versus the 8-week covered period. And again, the 8 weeks is naturally less than the 12 weeks. So if you're just paying somebody the same rate, you'll find yourself actually reducing their pay by 33%. Now, the AICPA obviously has caught on to this and said, now wait a minute, we need to basically say that if you're paying somebody the same rate of pay per week, that shouldn't amount to a salary reduction. And I think that makes logical sense. However, that's not the way that the CARES Act is written. Let's move on to the next slide for an example here.
Sure.
You'll see here that employee B, if they earn $12,000 during the first quarter of 2020, their weekly average, assuming 12 weeks, that will be $1,000 a week. If you just look at the 8-week cover period, of course, there's 8 weeks there. If you pay them $1,000 a week, you will have only paid them $8,000. So according to the way that the CARES Act is written, you'll see that you've actually reduced employee B's wage by 33%. And again, of course, the AICPA has jumped in to say that's illogical. You're paying them the same weekly rate of pay, so there should not actually be a reduction here. So again, we'll wait to see what the official guidance says. I guess we all suspect that they'll, agree with the AICPA. I just think that it's illogical that if you pay somebody the same rate of pay, that you're automatically going to be cut down by this 25% reduction. That just does not make any sense. So move on to the next slide. Same sort of example, just goes to show you here, again, $12,000 during the first quarter, weekly average for this person is $1,000. If you drop them down to $6,000 during that 8-week cover period, you'll see that their weekly average is $750 a week. Okay, according to the way the CARES Act is written, you will have reduced that employee's wage for that period by 50%. But if we follow the AICPA's recommendation, you will have only cut that person's wage by 25%. And of course, that's the key indicator here, because as soon as you cut somebody's wage by more than 25%, then some of your forgiveness is cut down. So if you followed the rules here, according to the AICPA, none of your loan forgiveness would be shut down. If you followed the literal reading of the act, you would have, of course, a substantial reduction in your amount of loan forgiveness. Let's move on to the last one here. The last one, again, sort of illuminates the same thing. It's just a more aggressive approach. If you've basically reduced somebody's weekly average by 50%, you can see, again, a literal reading suggests that you've cut it down by 67%. But again, according to the AICPA's recommendation and logic, you would see that you only cut them down by 50%. And it's important to understand, we think that the reduction in loan forgiveness is only the excess over the 25%. But if we're going to follow that rule, then of course step one in this entire process in trying to determine how much of their wage was actually cut. In this example, you've got either 67 or 50% to choose from. Again, I think most people think that the AICPA is correct on this, but again, we'll have to wait for the official guidance.
Thank you, Mike. Go ahead.
And then the last thing is that if you have somebody that's got an annual salary in 2019, for example here, of $200,000, and you reduce their salary by greater than 25%, this will have no impact on your ability for loan forgiveness, because these rules do not apply for employees that were making over $100,000 in compensation during the prior calendar year. And then here's the last slide here that I just want to talk briefly about. Of course, there's all these steps and all the rules in terms of trying to calculate, what's eligible for loan forgiveness. There's kind of, they snuck in an interesting provision in here that basically suggests that if you've got employees that were laid off or their wage was reduced from February 15th to April 26th, you have an opportunity to restore their wage by June 30th. And if you do that, you will not be trapped by any of the 25% provisions under this specific step. Of course, you may have issues with some of the other steps that we've discussed throughout this seminar here, but you will not be affected by this. If you do not restore the wages that were cut during this period, then of course you could be significantly trapped by this particular step. So I think that's a very important thing that people need to pay attention to, that if you have somebody where you've reduced their wage during this specific period of time, you don't have to restore their wage immediately. You just have to restore it to its original condition, if you will, by June 30th. Again, you might run afoul of some of the other rules, but you won't run afoul of this rule.
Thank you, Mike. I apologize to the people on the call, but we're nearly out of time. We have a number of issues we want to talk about. The three of us will stay on. I assume you guys, we could all stay on till 4:30?
Yes, that's not a
Don?
problem for me.
Yeah, I can do whatever, Bob. Yeah, that's fine.
Okay, so let us go through these comments because we think these are important points to think about. We want to talk a little bit about the examples that Dr. Hunt was giving with respect to Harvard and Ruth's Chris and so forth, because that's changing the dynamic very rapidly and very quickly. In just a matter of weeks, we've seen, $20 million given back. So, I mean, there's an issue there that I think people need to be aware of, that we need to talk about so that you're comfortable with that. We've got a swamp of questions, a lot, over 50. What we'll try to do is answer some of the questions that we've seen commonly in the few minutes that we have together. And then we'll do one of two things. I'll have to confer with my partners here. We'll have to determine whether Mike and Dawn can do it, but we'll either have another phone call on Monday or Tuesday to answer every question that was given, or if it's really pressing and you need an answer, you can email any one of the three of us and we'll get a definitive answer to you as soon as possible. But we'll go through some of the questions in a few minutes anyway. And some of these points here will answer some of the questions. I did have somebody ask me, they had heard that the forgivable PP loans that are excluded from federal taxable income are accompanied by a federal tax provision under the Internal Revenue Code that the expenses paid with those would not be deductible. All three of us have long suspected that, ever since this was passed. It seems a little much, a little bit of a double dip if the federal government is going to give you free money and then let you take a tax deduction for the expenses you pay with that free money. And it turns out just last evening that there was a notice that's cited in your materials in the slides earlier that came out from the Internal Revenue Service that said these expenses will not be deductible. And that makes logical economic sense. Otherwise, the federal government would be getting beat down for the entire 350 million, now almost 600 billion plus another 40% for the savings on the tax deductions associated with these covered costs. So that's not anything that I think we have advised anybody differently of over the 35 days. We felt all along that was not going to be a deductible item. All that happened last night is we got confirmation of that from the IRS. Dawn, why don't you talk a little bit about the independent contractor and self-employed individuals, because I know you've really done a lot of work on that.
Sure. So the independent contractors, like I mentioned a little bit earlier, as an independent contractor or a self-employed person, you need to file a PPP loan on your own. You are not included in the company PPP application. And one thing to keep in mind is if you have employees, if you're a business, a sole proprietor, or an independent contractor, and you have employees, you get to report those employees on your PPP loan application, and you get to include a prorated portion of your self-employment income. So if you have Schedule C, you would report your employee payments for the year, and you would report a portion of your net taxable income. So if your Schedule C net taxable income was $50,000, for example, you would take that $50,000 divided by 12, multiplied by, actually, let me take that back. You take the $50,000 divided by 52, multiplied by 8. So as a self-employed person, that's the number you would use for your application. But again, as a self-employed person, you get to apply for the PPP loan. PPP loans and partners, and I mentioned this a little bit also. Partners in partnerships do not get to apply for a PPP loan on their own. They are to be included on the partnership's PPP application, and it's to the extent of self-employed income. Okay, so the next bullet point, loan forgiveness applications and their timing. So, I mean, after the 8-week period, when we spend all of our money and we want to apply and fill out the paperwork to give to the bank, for the bank to review our information. Now, for the loan forgiveness, it's the bank that's going to review the information and make a suggestion or provide the guidance to the SBA. My understanding, our understanding, is it's not the SBA making the decision. It's the bank that goes through and approves the loan for forgiveness. So what we are suggesting to our clients is make sure you're in contact with your bank, make sure you're connecting with your bank so you know what they are going to expect from you. It's very important to keep accurate records of all the money that's spent. So if it's spent on payroll, you're going to have to reconcile the amount spent on payroll with your 941s so you can document that the amount of money you received from the PPP loan was used for payroll purposes, and you need to document and be able to support the other money that was used either for rent, mortgage interest, or utilities. I know a lot of you on the line are accountants. A lot of you are CEOs, CFOs. And I know you know how to keep the records. Generally, what we've been seeing and talking to our clients about is just putting a detailed Excel schedule together that shows an 8-week period, that shows your expenditures over that 8-week period for the categories that are included, summarize it and provide support, your 941s, and make sure you're in communications with your bank so you know what they're going to expect. We don't know if the banks are going to provide their own forms or if the SBA will provide something for you to fill out. Bob, do you have a comment?
Yeah, I was just going to add to that. I mean, it's pretty clear that they're going to want to see some kind of evidence. And that evidence is going to have to be in the form of federal tax filings, right? Because it's going to be your 941s. But your 941s are not going to align with the 8-week periods. So there's going to have to be detail in the schedules that Don's talking about that basically reconciles, the 941s with the data from the application period, which included 941s. And I concur. I mean, we've talked about this in our office. There's no question that most of the banks will have their own form. We just don't know exactly what that form is going to look like. Let me ask you guys a question as well, Mike, Don. When is the earliest that an individual can apply for forgiveness? The program is valid through June 30th, right?
Yes. I haven't seen any specific guidance, Bob. What I would recommend is connect with your bank, and I think you want to be first in line. There have been 1.6 million loans, PPP loans, made thus far, and that was the first round. You don't want to be too far down that list. You want to know relatively quickly whether you need to come up with more information to get to your bank so they can submit it to the SBA. The banks are required, according to the statute, to submit a report to the SBA within 60 days of receiving the documentation from a borrower. So the banks are going to be super, super busy here. So two things of what I'd mention here. First off, if you need help as one of our clients or potential client, if you need help putting this information together, reach out to us. We can help you do that. We have the expertise. We understand the law. We're going to be paying attention to the changes coming down the pike. So we will be able to help you gather the information and put it in a workable form to provide it to the bank. For all the banks,
unfortunately, we're not going to be able to. Unfortunately, we're not going to be able to do that until the guidance comes out, till the bank digests it. The banks, not one bank, the banks, and once they digest it, they'll develop their procedures, and at that point, we could customize whatever assistance you might need to meet your bank's requirements, so that it goes through without a hitch. The other thing I would say on this process of getting loan forgiveness is, as Don said, there's 1.6 million people going to be asking for loan forgiveness, and they only have a 60-day turnaround. So they're not going to have time to really press through all of this in the greatest of detail. And as a result, I would wholly expect that you would have to sign another certification that everything in that package that is given to the back of the bank was spent in a manner that you agreed to when you borrowed the money in the first place. So keep that in mind, because it's almost certain, since they don't have the time to do that, they're going to basically put that penalty opportunity on them if you misrepresent the information that's going in. And I don't think, most people are not going to misrepresent it, but you want to take the time to make sure you get it right for two reasons. One is to beat the certification if anybody ever challenges that. The other is to get the maximum loan forgiveness you can get.
Hey, Bob, we have, just on this particular point, there are several people that commented in the chat window here that they have received information from their banks that say July 1st is the first day that you can apply for loan forgiveness. So we at least have two people saying that's what the bank is saying. Well,
that makes sense to me because June 30th is the end of the program, right? It ran from somewhere in the middle of February to June 30th. So I just don't know if you got one of the earlier loans and your 8-week period ended May 24th, could you apply that day? But it sounds like from information on the phone shared by participants, and we appreciate that July 1st, the day after the end of the program, will be the first day to apply for forgiveness.
Bob, do you want to talk about that last bullet point there, financial reporting matters?
No, you didn't even tell me that was on there. No, what do I know about financial reporting? I mean, I really don't have a lot to offer on there, just because I wanted to talk to my partners in our audit and the assurance services group, but I really haven't had an opportunity yet. I know that obviously these are true liabilities until they're forgiven. The question that I don't have an answer to, and you may know, Don, since you so rudely threw that over to me, is whether or not that debt forgiveness is going to run through the P&L as an extraordinary item. John, if you're listening out there in the listening world, you can answer that for me, and I'll tell the participants whether that money that's forgiven will be an income element. It would obviously be non-operating, of course, or whether it would be a direct grant to equity and just be a balance sheet matter. And that's an important consideration, but we'd have to figure that. I don't know the answer to that today. I'm sorry, folks.
Now the other thing, I didn't expect you to answer that, Bob. I apologize for that. The other thing is, what effect does that have on EBITDA? Because there are a lot of calculations at different companies that are based upon EBITDA. So EBITDA, and I'm sorry, I'm a tax guy, so I don't know how it comes into play with respect to EBITDA or not. But EBITDA has a lot of consequences for bonuses and year-end things. People. So Bob, why don't you go to the next slide? I think that ties right into.
Before we move to the next slide, the world of modern technology, John Yannick, one of our audit assurance services partners, already got back to me. This is going to be recognized as other income and non-operating. So that will be factored into the P&L and calculations to drive out of the P&L as you go forward. Thank you, John.
Hey, Bob, did he send that to you in a Post-it that's typed?
He just sent me a text or an email.
Okay.
Hey, don't be getting on John when he sends us help, pulls us out of the water while we're drowning.
Hey, a couple other things, a couple other non-PPP items here. The first one, that I have there, the net operating loss rules. Those have been significant for some of our C corporations and also some of our pass-through companies have had losses. We probably have calculated I'm guessing $5 million of refunds with respect to net operating losses. So it's very important if you're a C corporation that somebody needs to look back over the last 6 years, to see if you need to look at 2018 and 2019 to see if you can carry those losses back. If you had losses in either of those periods, you can carry those back as far. 2018 can go back as far as 2013. So like I said, we've processed at least $5 million of refunds. So that's very, very important. And that kind of ties into the AMT credit changes also. For tax years when we're going backwards, we're able to free up all of the alternative minimum tax credits for corporations. And those can be, we had one that was over $100,000. So those are also significant. Okay. Individual tax rebates and individual tax changes as a result of the CARES Act. A lot of people haven't been paying attention to that, but there were quite a few changes that affect individuals, including the elimination of required minimum distributions in 2020. So, there's still a lot of things to be concerned with and be thinking about And if you're not up on some of that stuff, go onto our website, our homepage, and you can see some of the tax documents that we dropped on the homepage over the last 45 days.
Yeah, on the webpage, there's a coronavirus resource section, and everything is listed under there. And our marketing team has done a great job of getting that on there. I would add, on that required minimum distribution thing, I don't want to get too far off the tangent of PPP loans. That's a big deal because the market's dropped like a rock, obviously, because of this. Now it's come back some in the month of March, but it gives retirees whose RMD for 2020 would be based on the balance in their account at the end of 2019. It gives them a chance to bypass the current year's distribution, which will not only save them tax money, of course, but at the same time will give their investments an opportunity to climb back up to maybe get closer to where they were at the end of 19. State tax consequences of the CARES Act. The big one is whether or not the forgiveness that you may be able to obtain at the federal level will be forgiveness for the state level. And the answer to that is, unknown, but I doubt it. In most states, very aggressive stimulus ideas or initiatives undertaken at the federal level are often decoupled from state tax law. And Pennsylvania has already made a determination that that is not going to be tax-free to them. Now, on the other side, in light of what came out last night, the guidance from the IRS that said the expenses paid are not going to be deductible, in Pennsylvania, they are going to be deductible because you're not going to have the loan forgiveness. So it should theoretically be a wash. It's not necessarily economically a wash, but from a state liability standpoint, you shouldn't have an effect there. The only other state that I'm familiar with that we have clients in locally that may be on the phone call, West Virginia. West Virginia is a static state, meaning that every time there's a federal law, they have a congressional session to vote on whether or not they're going to incorporate those federal rule changes into the West Virginia tax changes. They just did that in February, a couple of months ago February just recently, to incorporate the changes in the Tax Cuts and Jobs Act from 17, but they said that all of those changes in that particular tax act are applicable for West Virginia for 18, 19, but now, 20, they'll have to have a whole new session, if you will, in Congress or in their legislature in West Virginia to make that determination. I would say on the safe side, you should anticipate, no matter what's forgiven at the federal level, no matter how many states you're in, plan for the worst, which would be taxation in those states of that income. And for federal, you get whatever benefit you can. Don, anything else on that?
No, Bob, I don't have anything else on that.
Okay, so we kind of talked about the financial reporting related matters, or as we've talked about as much as Don and Mike and I have the capacity to talk about it. Let's talk for a little bit about these optics that you're seeing in the news and the media with respect to big companies borrowing funds through this plan program. This has caused a great deal of angst to our clients, and we've had clients who have made they had a carefully thought process in initially applying for the loan, and now they've had a correspondingly similar thought process in deciding to give the monies back. So it's all based on the certification that was in the law there, and obviously people had to certify through that legislation or through that loan application process that due to the uncertainty in the economy, they needed those funds. Now it seems a little bit like, and I'm not saying this happened for sure because we don't know, but it seems a little bit like they're looking more for a mechanical calculation, kind of a stress test of future expectations through your company's projections or whatever, and basically you being able to demonstrate as the borrower that you actually needed those monies. Now, I don't know exactly how any audit process would actually happen here, but they have said last week in a notice from them that every single loan over the gross amount of $2 million is going to be detail audited. So even though we were able to, we being advisors as well, we were able to help people get those loans ready and get them to the banks, and the banks processed them very quickly. You heard the numbers that Dr. Hunt mentioned before. what they're going to do is come back on an end around, and they're going to audit these loans. So it's going to behoove you, as Don mentioned earlier, you need the records anyway to collect what you need for the loan forgiveness. But on the other side, you're also going to need some kind of financial records or narrative or discussions in your files as to why you thought you needed the loan and what your justification was for going to that loan. And while it was not spelled out, in fact, I think it was spelled out in the opposite, in the loan application process. They did not say that you could not have other resources for borrowing. What they said is, for these loans, that traditional requirement that if you had other sources to borrow from, it's not going to really matter here. So I can tell you for a fact that we know we have clients that had material alternative sources for funds that borrowed under this program. And that was okay. That was legal when they passed the law, and nobody did anything wrong. But now they're taking a more harsh attack. And since these provisions fundamentally changed the Small Business Administration law, not the Internal Revenue Code, the SBA has the power to interpret this as they deem appropriate, almost like issuing regulations to guide that. And that's what we've seen in conjunction with the frequently asked questions and so forth, that they issue guidance which wraps up or walks right on top of the law itself, or lays on top of the law and adds other requirements, much like the 75-25 requirement I mentioned. So the reality is that people have to be careful with this. And even if you borrowed less than $2 million, I think it behooves people on the call to basically put together their argument for why they needed this loan in the first place. It's hard to imagine that they're going to be auditing people that borrowed $235,000 or $380,000. But once you get up in the $1 million range, and obviously over the $2 million range, since 75% of the loans were only 150, there's only 25% of loans that are over 150. And if I had to bet, out of that remaining 25%, there's probably only 10% over $1 million. So there are not as many loans out there as possible. When you think about auditing, they could go after a lot of people and try to change that. Now, I have no idea, as I said, what the repercussions would be. I don't know how they could basically allege any kind of malfeasance when you haven't done anything other than follow the law in the application process. Nevertheless, you have to be aware of that, and you have to be concerned with the idea that that's a possibility for anybody that borrowed money, especially those of us on the call that, those of you that borrowed more than $2 million. Don, you got anything to add to that?
Yeah, the only thing I would add, and I don't want to go into a whole lot of detail because until we have guidance, there's just really no way to know. And hopefully the delay in the guidance is because they're trying to figure out how to address this particular problem. Over the last 7 days, there have been 2 notices that have come out in the facts and the FAQs. They have addressed it 2 different times. In the first time, they talked about companies that have that are large companies that have access to capital, and then they also addressed in the second FAQ that came out this week the exact language. Sorry, I lost the question. The exact language was, here it is, businesses owned by private companies with adequate sources of liquidity. There's just so much of this is so vague that until we have guidance, I'm not even sure that we can make a decision as to whether, we would advise somebody that they should give the money back. Like Bob said, I think a lot of it depends upon materiality. There's a very big difference between getting a $5 million loan versus a $150,000 loan. It's just a very big difference there. And we're going to be paying attention to the guidance as it comes out. And hopefully there's going to be some information in this guidance that's going to lead us down, one road or the other as far as how we address that particular problem.
Yeah, and I think, they haven't had time, obviously, to digest everything that's happened here. If they find out that Ruth Chris of the world, the Harvards, borrowed 1% of the money at the end of the day, I think a lot of this is just political, political hype as you would expect from the opposing party that's not in the administration, especially in an election year. So you really don't know accurately, as Don said, where that's going, but we'll keep people informed that if you have questions, again, www.gyf.com, our coronavirus site. Hey, Dawn, let's take a few questions. I'll read a couple off and then we'll mix them up who gets to answer them to give some of the answers to these. And if you don't, as I said, get your questions answered, feel free to basically email us, or I'll speak to, the three of us will talk, and if there's a time when we can put it together early next week to have a call just to answer questions, then we could print them all out and answer them as quickly as we can. So the first question is, yeah.
Bob, real quick, just so everybody can kind of understand the way people are thinking with respect to some of these things. I had somebody ask today, not really asked, more commented that, in light of this $2 million rule that's out there, that the SBA will audit loans over $2 million. Of course, we heard today that you can take back all or some of the money. So could business owners be in a position where, let's say they applied for a $3 million loan, got the money, gave $1 million plus of it back to get underneath the $2 million number and would not have to be audited by the SBA? Obviously we don't know the answer to that, but just shows you kind of all the creativity, if you will, that's out there. So that's one thing I just wanted to point out for everybody to hear.
No, that's a good point, Mike. And I mean, at the end of the day, as everybody on the call understands, it's not so much an issue of did somebody break the law in applying for such a loan. It's more of, again, an optics issue. And I don't know what tools the SBA or Treasury would have to force people into a situation that required a repayment of the whole thing at one time. It's certainly not part of the statutes, any testing or oversight. So the reality is, they created this situation. I think they created it not intentionally, but I think they created it in the hope of getting the money into the economy as fast as possible, and it kind of happened. But I think, again, as I said, if it ends up only being a handful of percentage points, 1, 2, 3% of all the loans, and all the other loans went to the smaller businesses like Don had mentioned in his stats, hopefully there's less audits and it's not the big thing that they seem to want to make it this week. Let me read a couple questions, and we'll do a few questions before we go, and then we'll just rotate around, guys. The question is, would a discretionary / retention bonus to an employee count in the PPP? And my assumption is that they're talking about covered payroll expenses, and if you paid somebody a hazard bonus or a discretionary bonus for staying with you through this or coming back early, will that count in the determination of how much of the PPP loan was expended for covered payroll expenses? What do you guys want to take that?
I'll comment on that. One of the things that Dr. Hunt talked about during some of my conversations with her, and she mentioned it today when she was on, is using the funds in the same manner that you completed the application. So obviously when you completed the application, most people took their 2019 payroll, divided it by 12, multiplied it by 2.5. Okay, so when you're doing your calculation of your payroll costs over the 8-week period, you need to be somewhat consistent with that original calculation, which means that if you pay bonuses once a quarter, then you probably should be able to include those bonuses in the calculation if it falls within that period. Or if it doesn't fall within that period, perhaps the answer is you just prorate the bonus to fit it into that 8-week period. Because at the end of the day, if you're following what you did in the application was approved. As long as you're following that, it seems like that should be the test. Do what you said you were going to do with the money. And what you said you were going to do with the money during the application process was based upon your payroll that you paid last year.
Yeah, that kind of bodes a follow-on question I'm just looking through some of these. How about bonuses, Don? If you paid a bonus in 2020, which would end up on individuals' 2020 W-2s, of course, but earned in 2019, is that included in covered payroll costs?
I think, Bob, you look at, did you do that last year? Was that done in 2019? Again, you're following how you prepared the application. When you prepared the application, you probably just took your total payroll. Maybe you took your monthly payroll, but a lot of people, I think you just took your total payroll divided by 12. So if your prior year bonuses were included, you would think that you would be able to include your current year bonuses.
Yeah, I think that's right. I think consistency is the answer here, and it would seem like whatever you predicated the borrowing calculation on, you'd want to assimilate something similar or put something together similar in answering how the money was spent. Again, hopefully we'll get a little more detailed guidance, but I think Dawn's right on there. Hey, Mike, here's a question from someone. We're having problems with employees returning, as one of you mentioned. I don't remember which one. Some are afraid and others are making more on unemployment than wages. It's a great country, isn't it, folks? Can you hire new employees to replace them? And does the new employee wages count against the thresholds?
Yeah, there's no provision that it has to be the same employee that you hire. It's just that you have to, make an attempt, and obviously to follow Dawn's step there, measuring the full-time equivalents. There's no provision that it has to be the same person. It can be anybody. So you can hire a new person, still satisfy those rules, and have the other person step into the wage. So again, it doesn't have to be the same person. It can be a new person.
Yeah, and I think the follow-up step there is you need to get that other person off of unemployment. I don't know how you do that, right? Practically, you would say, you report it, this person's not on unemployment anymore. But we all know, anybody who's ever had to fight an unemployment issue knows that whenever you walk into that unemployment office to fight an unemployment claim, you're going to lose as an employer.
If my brother's on the phone out there, he would attest to that for you. How about this question, guys? We pay a substantial amount of interest that is not mortgage related. Can this be used for operating costs and along with rent and utilities? I'll take that because I think I mentioned that when I went through my slides. I don't think interest that is not mortgage related is going to be considered in conjunction with being a covered expense. I mean, they're very specific in the language of the statute, both in 1102 and 1106 of the CARES Act, as to what is an allowable expense. And it really is those 6 items that I read on the screen. I don't know if you guys have any other commentary on that.
No, I agree with that.
Okay, understand that the mortgage interest does allow, mortgages on personal property. I'm not exactly sure what that means. I know you don't get a traditional mortgage on a piece of equipment, but I don't know if it's just any liened property that it will count or not. And I think that'll be answered in the next guidance. But the assumption is that it's either one or the other, the real property or the real property and the personal property, but no other interest beyond that. And the other part of that question, I believe, was can it be used for other operating costs? If you're outside the realm, if you will, of that, if you're outside the realm of that definition of other covered expenses, then no, it's not going to count against the forgiveness, and it'll be amounts that will have to be paid back to the organization. Does the payroll amount for forgiveness purposes, okay, so we're talking about forgiveness, does it now include total payroll and no exclusion exists for folks making greater than $100,000 annually? Dawn, you want to grab that? One of you guys got that one?
Yeah, gross compensation, sorry, I want to make sure I wasn't on mute. It includes gross compensation plus benefits. So you can have somebody who gets paid cash compensation of $100,000. You would divide that by the payroll periods. So you can be at $100,000 cash compensation plus benefits. So if benefits cost $30,000. In reality, you're looking at $130,000, and then you back that into the payroll period, the 8-week payroll period, and that should have been how you did your application. So if you were approved for that original amount, you would do that calculation to determine how much of it is forgiven.
Okay. That would be the same answer if that person was making $150,000 of compensation. You still get to exclude the first $100,000.
That's correct.
Of compensation, yeah. So you still, even if somebody's making, I don't know if they were trying to get at that also in that question, but if somebody's making over 100,000, you could still exclude up to 100,000.
Okay, let me see. I get one more here before we sign off. How about
Hey, Bob, I've got a couple. You want me to read a couple?
Yeah, go ahead, Dawn. You don't have to wait for me. Let's keep people invested if we can, for sure.
Okay, so in calculating the 75%, are the FICA and tax withholding amounts included in the amount used for payroll? And the answer to that is no. When you're looking at payroll costs, you exclude taxes, either both employer and employee.
Yeah, I agree with that completely. There's no question about that. If you do have income taxes assessed to you as the employer at a state level or local level, which is not something that's very common to Western Pennsylvania, I've never seen that, or I rarely seen it if I've seen it at all. Those state and locals are, but not the federal taxes, as Dawn said. I agree with that completely. All right, next
question. If you meet the 75% threshold, are there restrictions on what you can use the remaining 25% on? The answer to that is yes, there are restrictions, and that would be the rent, mortgage interest, and utilities.
Here's a question, I think off the same listing, Dawn. How would you suggest that we set up our banking accounts to make accounting processes easier in accounting for the money borrowed under the PPP loan? I mean, that obviously is going to be fact sensitive to every particular business that borrowed money. But at the end of the day, it's as simple as doing what you need to do to provide a proper accounting of all expenditures under here. Many of the clients that we've talked to and companies have opened specific accounts for those. And it's noted here that there's alternative accounts as well. I mean, if you have monies coming into a main account that have to be moved to this alternative account or vice versa, that's fine. You just have to make sure, again, that you're running a very tight accounting ship here for both reasons. One being that you want to qualify for the forgiveness, of course. The second being that you don't want to put yourself in a position that if anybody ever examines you, that you can't fulfill the examination requirements.
Yeah, and Bob, I've heard that several banks are requiring you to put that money in a separate account. So you might
yeah, I've not heard that, but I think that's a good idea. I think it makes perfect sense. I know a lot of people are.
Another question, are there restrictions on the use of EDIL loan money? And as Dr. Hunt mentioned, you can use the EIDL money for anything. There are no restrictions there.
Okay. And the last question is, someone talked about term debt and said, would interest on term debt that was borrowed in the past, was in place on February 15th for past acquisitions, is that interest a cost that's covered under the loan forgiveness? And I would suggest that's not. Perhaps in an asset acquisition deal and certain debt is secured, when we get guidance, that might envelop that interest, but I would say that's more unlikely than not that we get there. So we're running out of time. I'm sorry we didn't answer all your questions. We will, you have my word, we will look at every question that you folks put on the internet. We'll answer as many of them as we can. We will perhaps have another question and answer session, or maybe what we'll do is set up a second call to cover the guidance when it comes out next week. And then at the same time, we can, add an hour to answer the questions. We'll have a better opportunity to see them and know what's on there. I know you've been patient. We appreciate everybody's attendance. I would tell you, we do many presentations here, and over my career and over 30 years with the firm, we've done a lot of presentations. Most of them are live though, but there are benefits and detriments to both ways, whether it's live or on a webinar. Obviously, if it was live, we would have given everybody a muffin. So you're kind of out of luck there. But on the upside, nobody had to comb their
possibly a virus.
Yeah, possibly, that's right. And on the other hand, nobody had to get out of their pajamas or comb their hair today. So that's not a bad thing either. So we appreciate your attendance. We hope that we've conveyed some useful information to you. The three of us are absolutely available at any time to try to answer calls. That doesn't mean we'll be on the other end of the phone. When you call, somebody else might have called right in front of you, but we'll get back to you immediately if you contact us by phone or email, and we'll follow up, as I said, the way we did before. We would like you to send comments to Carissa, the invitee, and her name is on here as the administration person. She's the one with the big J, J-A-N. Carissa will put those comments together for us and help us improve and do a better job the next time we all get together. We appreciate your attendance today. Again, we reiterate that if you go to or make it one of your favorites, www.gyf.com. And we have tax developments, accounting and assurance developments, and a lot of coronavirus developments on there almost daily. So there isn't time in the world we're living in now to type them up and send them out as alerts. So we encourage all of you to get on there and regularly and take a look at that. Thank you for your attendance today. Guys, you have any closing remark?
I have nothing. Thank you, everybody.
Good. Thank you.
Okay, well, thank you, Mike. Thank you, Dawn. Take care, everybody. Bye-bye.